Inflation and tariffs are two powerful forces that can significantly impact a business's value. But how do they do that? Let's talk about that. Inflation, particularly rising costs of goods and services, directly affect the company's bottom line. More costs, less money in your pocket. When inflation increases, businesses face higher operational costs from things like raw materials to labor and other factors. These increased costs eat into profitability and margins, ultimately lowering the company's business valuation. In business valuation, we account for these changes by adjusting financial projections or add increased risk. We'll also consider how inflation impacts a company's ability to pass on these costs to customers without losing market share. Tariffs, on the other hand, especially when they impact imported goods, can similarly have the same types of disruptions. Businesses that rely on foreign suppliers may face increased costs due to the new administration standards, which reduce margins. For companies that import goods from countries with high tariffs, these costs can be factored into their valuation. We assess the impact of tariffs by evaluating the company's supply chain vulnerability and its ability to absorb these costs or pass them on. If the business can't pass them on, their profitability will shrink, decreasing the overall value. Inflation and tariffs are unfortunately real-world risks that businesses face every single day, and they can have a dramatic impact on the business valuation. A thorough business valuation and appraiser will always factor in these external economic factors, adjusting for future trends and ensuring that the business's value is as accurate as possible. At Peak Business Valuation, we integrate these factors into our analysis, ensuring your valuation reflects a true impact of economic changes. Want to learn more about how inflation and tariffs affect your business's value? Please contact us today and let's get started on your business valuation.